Let me be completely straight with you right now. Most people watching this video are going to start their week the exact same way they started last week, checking their portfolio, seeing some green, maybe feeling pretty good about things, and then doing absolutely nothing different. And that is exactly why most people consistently underperform the market. Because here is what Wall Street doesn't want you thinking about on a Monday morning. The signals that move markets don't arrive with a warning label. They arrive quietly weeks in advance, buried in data that 95% of retail investors completely ignore. This morning, I am breaking down exactly what those signals are telling us right now in May 2026 and why I believe we are standing at an inflection point that could reshape portfolio performance for the rest of this year. Stay with me for the next few minutes, because what I am about to show you is not a prediction, it is a pattern. And patterns, unlike predictions, have a track record. Pause for effect, and before I get into it, if you are new here, hit that subscribe button right now. Every Monday morning, I break down the week's most critical market data so you can walk into the week ahead of the crowd, not behind it. You can always unsubscribe if I waste your time. But I don't think I will. Let's get into it, okay? Let's set the table. As of Friday's close, here is where we stand. The S&P 500 is sitting around 7,270. The Dow Jones is hovering near 49,328, and the Nasdaq closed above 25,351. Now on the surface, those numbers look fine. Markets are up on the week. Some earnings came in strong. Crude pulled back a bit from its spike. Risk appetite returned. Easy to look at that and think, okay, we're good. But I want you to think differently. I want you to stop looking at where the market fay and start looking at where the market cold be going based on what is actually happening underneath the surface. Because here is the thing about the week we just lived through. Monday last week was brutal. The Dow dropped 557 points in a single session. The S&P fell 30 points. Oil prices spiked on renewed Iran conflict fears. And most of that was erased by Tuesday when oil pulled back and earnings surprised to the upside. That kind of violent intraday reversal, that is not noise. That is a market that is incredibly sensitive to a very specific set of macro triggers. And when a market is that sensitive, you need to know what those triggers are, because the next time one of them fires, the reversal might not come as quickly. Let me show you what I mean. There are 3 warning signals I want to walk you through this morning. Each one individually is something you could explain away together. They paint a very specific picture of where this market is heading. Let's start with the Federal Reserve, because everything in this market runs through the Fed. Here is the situation. Jerome Powell just completed what was likely his last FOMC meeting as Fed chair. His term ends May 15th. Kevin Warsh is expected to step into the role, and the handoff is happening at one of the most complicated moments the Fed has faced in decades. Why? Because inflation is reaccelerating. March CPI came in at 3.3% year over year, up from 2.4% in February. That is not a small jump. That is a meaningful acceleration, and a lot of that is being driven by energy. Gasoline prices surged 21.2% month over month. That kind of move flows through the entire cost structure of the economy: transportation, logistics, manufacturing, food, everything. Now here is the trap. The Fed is in. They want to cut rates. The market wants them to cut rates, but the data, specifically this inflation data, gives them absolutely zero room to do it. Multiple Fed governors have already dissented on the idea of future easing. There is no clear basis based on current data to signal rate cuts are coming, which means something has fundamentally changed from where we were 6 months ago. 6 months ago, the consensus was that 2026 would see multiple rate cuts. The market was pricing that in. Value stocks were rallying, small caps were getting attention, cyclicals were moving. Now rate cuts are effectively off the table until well into 2027. Think about what that means for the rotation trade that started the year. All those investors who moved into rate-sensitive sectors, value, small caps, cyclicals, based on the expectation of falling rates, they're now sitting in positions built on an assumption that no longer exists. That is a setup for a reversal, and reversals create volatility. Now, I want to stop here for a second and ask you something, because I am genuinely curious. Are you currently positioned for a no rate cuts in 2026 environment? Drop your answer in the comments right now. Are you leaning defensive, staying aggressive, or somewhere in between? I read every single comment, especially on this channel, because we're still building this community together, and your input actually shapes what I cover next week. Okay, back to the warnings. Let's talk about oil, because this is the wild card that nobody priced in at the start of 2026, and it is the one that is now structurally reshaping the market environment. The Iran conflict hit in March, oil spiked. Markets sold off, then it seemed to stabilize, and a lot of investors understandably started treating it as priced in, as if a situation that complicated was just going to quietly resolve itself. But here is what the data is actually showing. The International Energy Agency revised its 2026 global oil demand forecast in April, projecting a Q2 contraction of roughly 1.5 million barrels per Dalton Y. That would be the sharpest demand decline since COVID-19. And it is not just demand. The conflict has reached what one analyst described as a hardened standoff. The formal ceasefire holds, but the economic standoff continues. Iran retains the ability to selectively restrict traffic through the Strait of Hormuz. The U.S. is maintaining a naval blockade of Iranian ports. The underlying dispute still completely unresolved. What that means in practical terms, oil price volatility isn't going away. It is a persistent threat. Every week that passes without resolution is another week where energy prices can spike on any piece of news, and we saw exactly how fast that can ripple through equity markets last Monday. And here's the compounding issue. The market's April rally was built on an assumption that the Iran situation would resolve relatively quickly, and that energy prices would normalize. That assumption has not been validated. We are still waiting for evidence that it will be. US Bank Senior Investment Strategy Director put it this way. The key risk today is whether the Iran conflict leads to sustained increases in energy and transportation costs that feed into inflation, interest rates, and stock pricing. If higher costs persist long enough, investors may reprice growth expectations downward and demand a larger risk premium. That repricing. That is what a market shift looks like. This is the one most retail investors miss completely, because when you look at the headline indices, things don't look bad. But when you look underneath the headline indices, the story changes. Here is the setup. Since late 2025, we've been seeing what technical analysts call a bearish divergence, a situation where the index makes new highs, but its most dominant components are quietly deteriorating. The Magnificent Seven stocks, the mega caps that drove the market's performance for 3 straight years, started showing weakness back in July of 2025. And it spread. By early 2026, financial stocks had also put in what looks like a completed 5-wave advance, meaning in Elliott wave terms, they'd run as far as that particular move was going to take them. Lower lows followed now. I am not here to make a doom and gloom call. I am not saying the market is about to collapse. But what I am saying is this. The conditions we're in right now match a very specific historical pattern that tends to precede a sustained corrective period, not a brief dip, but a complex multi-month rotation. The analysis out of IO Fund, one of the most closely watched technical research shops in the space, lays out what they're calling a globally synchronized topping process. Markets around the world completing the same technical structure, the same deterioration in breadth, the same loss of momentum. If that analysis is right, the volatility we experienced in April was not the end of something, it was the beginning, and the line in the sand, the signal that would invalidate this bearish technical picture. It is specific. A weekly close at new all-time highs in the Nasdaq -100. If the QQQ breaks out and holds on a weekly close, that changes the conversation. Until that happens, the weight of the technical evidence points toward caution now. I know what some of you are thinking. If things are this complicated, why did markets bounce so hard on Tuesday? Why are earnings coming in strong? Why isn't everything already falling apart? Fair question, and I want to answer it honestly. Because here is the thing about good investing. It is not about picking a side and defending it no matter what. It is about understanding the full picture, bulls and bears, and positioning accordingly. So let's talk about what is actually strong right now. Corporate earnings are genuinely impressive. The blended net profit margin for the S&P 500 in Q1 2026 came in at 13.4%. The highest level ever recorded since FactSet began tracking this metric in 2009. That is not a projection. That is actual reported results. Companies are executing. Margins are expanding. This isn't a fake rally built on multiple expansion. Earnings are doing the real work. Information technology posted a Q1 net margin of 29.1%, up from 25.4% a year earlier. That is extraordinary, and it is being driven by AI monetization actually showing up in the numbers, not just in the hype. The AI capital spending thesis is maturing. Something interesting happened in this earnings season. Investors are no longer just rewarding companies for announcing big AI capital spending. They're now distinguishing between companies where that spending is starting to show returns and companies where it is just a massive open-ended commitment. That is a healthy evolution. Markets are getting smarter about this trade. Earnings growth estimates for the full year remain strong, above 20% according to Bloomberg FactSet and S&P Capital IQ. That is the foundation this market is standing on. And as long as that foundation holds, the bull case isn't dead. Market breadth has actually improved somewhat. While the Magnificent Seven concentration remains a concern, U.S. bank notes that wider participation in the rally, more sectors contributing, has helped offset some of the geopolitical and sector-specific volatility. A broader rally is generally healthier than a narrow one. So what is the honest summary? The bull case is, earnings are strong, AI investment is paying off, and the economy is still expanding. The bear case, or more precisely the warning case, is that all of those positives are being challenged by a macro backdrop that is genuinely more complicated than it was 6 months ago. Both things can be true, and when both things are true, that is when you need a clear framework for how you are positioning. Which brings me to section 4 outright. Let's get practical, because I don't want this to be a video that just stresses you out and sends you off to your Monday without a plan. That is not what this channel is about. Here are the frameworks I am using to think about positioning right now. The worst thing you can do in an environment like this is make a confident all or nothing call. The second worst thing is to do nothing because you are paralyzed by uncertainty. The right move is scenario planning. Scenario A. The market shrugs it off. The Nasdaq -100 pushes to new all-time highs on a weekly close. Iran tensions de-escalate, oil prices normalize, the Fed signals flexibility as inflation cools in Q3 in this scenario. You want tech exposure, you want growth, the AI trade continues, the Magnificent Seven reassert leadership. Scenario B, the corrective phase plays out, inflation stays sticky, oil stays elevated, the Fed doesn't cut, earnings guidance starts to soften in Q2 and Q3 as cost pressures flow through the income statement. Markets churn sideways to lower through the summer. In this scenario, you want defense, quality cash flow. Real assets. Energy actually performs well in this environment because it benefits from the same oil prices that are hurting growth valuations. Scenario C, something breaks, a black swan, an escalation in the Middle East, a credit event, a surprise in the labor market. This is the scenario where correlations go to 1, everything falls together. Cash and short duration bonds are the only places that hold. Now, you don't need to know which scenario is coming. You need to size your portfolio so that you are okay in all three, and position to outperform in the one you think is most likely based on everything I just walked through. I personally am tilting toward a scenario B lean with a tail hedge for scenario C. I am not abandoning growth entirely. Those earnings numbers are real, but I am being thoughtful about where my risk is concentrated. This is the 2-variable dashboard I am using every Monday morning right now. If oil stays elevated, and the 10-year Treasury yield starts rising again, that is the stagflation signal. That is when things get really complicated, because there is no good sector rotation out of stagflation except commodities and real assets. If oil comes back down and the 10-year holds steady, that is the muddling through scenario. Markets can handle that. If the 10-year yield starts moving meaningfully lower, despite the inflationary environment, that is the signal that the bond market is pricing in a serious growth slowdown. And when bonds signal growth slowdown, equities eventually follow. These two numbers, watch them every Monday morning before the open. I want to say something that might be unpopular but is important. The Monday morning news cycle is designed to make you react. Every financial media outlet wants you emotionally engaged, clicking, refreshing, making decisions based on whatever headline just crossed the wire. That is how they make money. Your job is the opposite. Your job is to have a framework, a plan, and the discipline to stick to it, while staying informed about the genuine macro shifts I described today. The difference between a retail investor who underperforms and one who doesn't is almost never about picking the right stocks. It is about the emotional discipline to not make impulsive decisions during moments of high volatility Monday mornings, especially ones that follow volatile weeks like we just had, are some of the highest risk moments for emotional decision making. Be aware of that. Pause, review your framework, then act. Let me get even more specific. Here are the sectors I am paying close attention to this week. Energy, the obvious one. If oil prices remain elevated and the geopolitical situation hasn't changed, energy stocks continue to have a fundamental tailwind. I am watching the major integrated oil companies, but also the midstream players who benefit from volume regardless of price direction. The caveat, if a peace deal emerges quickly and oil drops 15 to 20% in a week, this trade reverses fast. So position sizing matters here, technology, but selectively. I said earlier that tech margins are at record highs and AI monetization is actually showing up in earnings. That is real. But I am distinguishing between Tier 1 AI companies, the ones actually showing ROI on their AI capital investment. These can be owned even in a challenging macro environment, because the earnings growth is genuine. Tier 2 AI companies, the ones that have announced massive capex, are building out infrastructure but haven't yet shown the returns. These are more vulnerable in a risk-off environment. AMD, for example, technically overbought with an RSI of 76.1 right now. Bullish momentum, yes. But when RSI gets that extended, you are buying into risk worth watching for a pullback entry. Defense and aerospace, this is the overlooked play in a Middle East conflict scenario. When geopolitical tension is elevated and sustained, as it is right now, government defense spending tends to increase. Defense contractors, missile systems, cybersecurity, these sectors have structural tailwinds in the environment we're in. Financials handle with care. I mentioned the technical deterioration in financials earlier. Big banks completed what looks like a significant five-wave advance off the 2025 lows and have been putting in lower lows since. That is a pattern that deserves respect. I am not aggressively adding to financials here. I am watching for the technical picture to stabilize before reconsidering. Consumer discretionary. The most vulnerable sector here is the sector I am most cautious about. And here is why. Consumer spending accounts for 70% of the U.S. economy right now. Consumers are facing elevated energy prices, both at the gas pump and in their utility bills. If inflation stays sticky and the Fed doesn't cut, the consumer gets squeezed from both sides, higher costs, and no relief on borrowing costs. Charles Schwab's chief investment strategist explicitly flagged this. If the labor market softens, inflation stays sticky, and affordability doesn't improve, consumption might look less robust in 2026 compared to 2025. Consumer discretionary, retail, travel, restaurants, entertainment. These are the sectors that feel it first when consumers start pulling back. Watch the retail sales data closely over the next few months. Let me zoom out for a moment, because I think one of the most valuable things I can do for you is help you understand what kind of market environment we're actually in, because that should determine everything about how you are thinking about the next 6 to 12 months. We are not in a simple trending bull market. We are not in a bear market. We are in something that Charles Schwab's team described perfectly, an unstable market. There is a difference between uncertainty and instability. Uncertainty means we don't know what is going to happen. Instability means the inputs keep changing rapidly, with shifting relationships between variables that used to move in predictable ways. In a stable bull market, the playbook is simple. Stay invested, stay diversified, don't panic. In an unstable market, that playbook still applies at the foundation, but it needs to be supplemented with more active framework management, knowing when to trim, knowing where your risk is concentrated, knowing what signals would change your view. Consider this: the S&P 500 has experienced an average intra-year decline of roughly 14% since 1990, even in years where the full-year return was positive 14%. In a good year, that is just market reality. Volatility is not a sign something is broken. It is a feature of how markets work. But the size and frequency of those intra-year swings tends to increase during periods of macro instability, and that is the environment we're in. Now, the Motley Fool's team summed up 2026 simply: investors were expecting a repeat of 2025. Instead, they got a major sector rotation, a war in Iran, and returning inflation, all in the first 4 months of the year. That is what an unstable market feels like, and navigating it well is about staying clear-headed, avoiding emotional reactions, and keeping your framework sharp, which is exactly why I am here every Monday morning. Okay. Practical, specific, actionable. Here is my watch list for this week. 1. Oil prices at the open Monday after last week's dramatic swing, down 1% plus Monday recovery Tuesday. The oil price behavior on Monday morning is going to set the tone for risk appetite. If crude is flat to down, risk appetite should hold. If oil spikes again on any news out of the Middle East, brace for another volatility spike in equities. 2. Treasury yield movement. I am watching the 10-year. If it starts creeping back up toward 4.5 minus 4.6%, that is a headwind for tech valuations. If it drops, particularly if it drops without an obvious catalyst, that is a potential signal of fear creeping into the bond market. Watch this number 3. Any Fed communication with the Fed chair transition happening this month. Powell's term ends May 15. Any communication out of the Fed this week is potentially significant. Markets will be reading every word from Kevin Warsh and the rest of the FOMC for signals about what the new leadership framework looks like. For consumer data, if any retail sales, consumer sentiment, or credit data comes out this week, I am paying close attention. The consumer is the foundation of the U.S. economy. Any cracks in that foundation start to show up in these numbers before they show up in stock prices. 5. Nasdaq negative 100 price action. As I mentioned, the technical line in the sand is a new all-time high close in the QQQ on a weekly basis. If we get that this week, it would be a meaningful signal that the market is pushing through these concerns. If we fail to make new highs and start putting in lower lows again, the corrective case gets stronger. All right, let's bring it home. Here is what I want you to remember from this video. The market is not falling apart. Earnings are strong. Companies are executing AI. Investment is showing real returns. The foundation is not crumbling. But underneath that foundation, there are cracks worth watching. The Fed is trapped by inflation. The Iran conflict is not resolved. The technical picture shows deterioration that historically precedes sustained correction. And the macro environment, oil rates, geopolitics, is more unstable than at any point in the last several years. The investors who will win in this environment are not the ones who predict it perfectly. Nobody does that. The investors who win are the ones who have a framework, stay disciplined, and adapt when the evidence changes. That is what we build here, every Monday morning. Now, here's what I need from you. If this video gave you one thing, one new idea, one framework, one data point, hit the like button right now. It sounds like a small thing, but for a new channel like this one, it is everything. It is how YouTube knows to show this content to more people who need it. It literally determines whether this channel grows or stays invisible. So if you got value, that one click matters more than you know. Second, drop a comment below with this. Tell me the one word that describes how you are feeling about the market right now. Cautious, confident, confused, excited. I am not joking about reading every comment. This is a community in its early days, and every single person in it matters to me. Your comment also tells the algorithm this video is worth pushing to more people, which is how we grow this together. Third, subscribe. If you are not subscribed yet, do it now. Every Monday morning, before the market opens, I drop a video like this one. Not hype, not predictions, frameworks, data, the stuff that actually helps you make better decisions. We are building something here, a community of investors who think clearly, stay disciplined, and don't get jerked around by the Monday morning noise machine. I'll see you next Monday.